Hey, greetings. Happy Thursday. Oh my God, it's Tuesday. I'm anxious for the week to get over. So let's just put it this way. Welcome to Macro to Micro Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com. And I am very glad to be joined by Jonathan Gibbons. We're going to bring him in right now and we're going to talk. Oh, yeah, raising his hand. We're going to talk about the market that is finally a two-way market. Very exciting. And basically what we have for micro action because macro's dead. It's just, Bitcoin took over. All right, here is Jonathan. We have right here, let me just kind of do a little housekeeping first and foremost. So this is my Tuesday macro to micro power hour. Jonathan Gibbons of VigTech.io, where we're going to talk options matrix and risk indicators and all kinds of market structure that we can glean from activity under the surface. And then once this is over, I will be posting this webinar and interview on my LaDuc Trading YouTube channel. So you can find it, just scroll down. Here it is, Macro to Micro Power Hour. I also put some insights in there once in a while, featured presentations, Women in Trading and Finance series, and risk indicators, which, yay, they are working great. I really like how they spied some of this action very early on. And with that, I'm going to stop sharing and say, hey, Jonathan.
What's going on?
Oh my God, I thought it was Thursday.
I know, I heard it.
We have a two-way market.
You called it. You were like, I knew when you, so when you sent me the message, broke macro, I was like, sure enough, Murphy's Law. You're gonna see it come back into play.
Well,
Right.
but seriously, the macro trade is dead. Long live macro. But you have this, unrepentant bond trade, dollar trade, rate trade is just sideways. The whole Bitcoin, excited about inflation. And of course, debasement, if you will, of currency, which we've talked about jokingly is not something you want to wish on your worst enemy. But basically, what else do you do? Bonds are just, sideways. Dollar is really flat with expectations of falling apart, but it probably won't. And then Yellen comes out and says, yeah, we should have higher rates. But, what are the chances? So it doesn't.
They don't believe her, obviously. Right? No one believes her.
No one believes her. But at the same time, we do have lots of macro to consider, like taxation, right? And market doesn't care. So all of a sudden, market just decided to drop through that 4170, which was the SPX level, otherwise known as a trigger for volatility. Mm-hmm. And it happened right at the open and went right down to 4130. So it was a really lovely sudden play, and now everyone's going, oh, we have the top. So we really don't know. This is one day, half a day. I don't know what you want to call it. But last time we talked, I keep actually for 2-3 weeks now, I keep showing that coiling NYSE chart, that coiling stock bond volatility ratio, coiling. It's gonna go. So today may just be day one. So we got to get some confirmation.
I saw I was kind of going on a little rant last night, on Twitter, because I talked about crypto and I talked about, small caps last week and how all these things were getting purchased and how they become sizable. And then when you went and looked at all of them, they just, since that conversation last week, just poo. And they were still being bought in the options side, but not as one-sided, more neutral, like between calls and puts, and still sizable though. So the size was still there, but it was switching. And then the underlying securities looked terrible. Then you look at all the IWM stuff. So that was the crypto related stocks. Then you look at all the IWM stuff, and IWM was like looking strong, but it was at one of those inflection markers where it needs to bust up and out, or it sets up for a lower high, and all the guts of it look really bad. And we'll look at a few of those once we start like digging into it a little bit, like fuel cell and plug and all these things that have been driving a lot of that. And so it's got left inside the IWM is the commodities carries, right? So things like that were, to me, it was like, all right, well, that was a fail. right? And then you got to acknowledge that. Then you see VIX start to like be shifting purchasing underneath the surface last week, which I pointed out because we can grab all that via the matrix. You can see that stuff starting to transpire. And I was like, well, and you had said, and I got this from you, I didn't, I've been so busy, I haven't really been in and out of everything. So I used a lot of the stuff you got coming across the table. It's like watching the gold as a problem, gold and silver. Gold and silver has a steady bid. And the way those are set up right now, they're set up in a position where I was looking at the long-term pictures of those and the underlying flows for those. And then we started seeing options bid yesterday, like strong call, block buying option side, like long duration stuff, not short duration. I was like starting to add up all these things. I'm like, well, this could get a little hairy. And then sure enough, today you get a little action. I don't know that this is the top, but I think that, the action is starting to shift, and you can see that action in the options landscape, which we've created that to view, but you can see it all green. Now it's yellow and red and some green, and it's clear as day. And then you start digging into some of this stuff. Now you're not seeing I still think VIX has got some shaking and shucking and jiving to do, but the macro seems to be, I've seen it get so ridiculous in inflation perspective that it's like we're in the other tail for inflation. And I was listening to Corey Hoffstein podcast with Jim Carson last night, and like they were talking about the right tail, left tail. I highly recommend. It's really good. And it really, we're in one of the other tails, which is still just as volatile and dangerous as being in the deflationary tail. And so for them to come out, they got to do something with this inflation. But what do? How does this work? And now they're talking about taxing all the gains, right? And the estates and the different things like that. People going to exit. I seen the thing you posted about everybody, exiting early, boomers retiring early. Well, yeah, I mean, if you're up 200% in the last 2 years, I mean, maybe be a good time to check out, right? Like, so that puts on a sell side bid. Yeah, I hadn't even thought about, right? So that's dumping into the market, right? So I think there's a lot of different things that I'm seeing that could come into play here. And you saw it, but just from a market structure standpoint, it's shifted. There's been a shift. Now, whether that follows through or not, I don't know, but genuinely a shift.
But the shifting, as you said, if we don't have volatility, we have rotation.
Yes.
Truer words were never spoken. I mean, it in a nutshell, that's the market. So we've had really momentum has stayed down, and safety has stayed bid. So whether it be the boring XLRE or XLU or IYT or XLL, XME, I mean, that the major ETFs that are basically value cyclicals, not cyclicals with tech, but the anti-momentum trades, XAR, I mean, aerospace, stuff that does not normally move like Jagger has been on gorgeous trends and many have not broken. My list actually just keeps going higher. In fact, today was ARNC and CVS. So Arconic, which was an Alcoa spinoff years ago. So those are really not what you'd call movers and shakers, but they're gorgeous. So my list for safety plays, which is that growth to value, has been building even while momentum is getting sold. And some is just bleeding, like Tesla is bleeding, AMD is bleeding. You got a lot of mid-cap tech, the high growth stuff, that's definitely in trouble. But it's interesting to me that really just recently have we had volatility. I mean today, just in time for this broadcast, have we really had volatility pop up to make folks say, ooh, maybe we shouldn't be complacent. So I wanted to show that kind of because the commodities are still bid. And if we get crude right now, which is about $65, dollars, and it shouldn't fundamentally be stronger, but if it starts to get bid, and if gold and silver, miners start to get bid, although I'm still really not expecting that. Like at a base minimum, I can see that they're getting a little stronger, but they typically trade with bonds, and bonds are still weak sauce. They have a lot of work. In other words, they're guilty until proven innocent. So for me, the bond gold trade is tied at the hip. And if they start to bifurcate, then I'm going to pay a lot of attention and again, oil and nat gas and things that really don't have a fundamental reason to move higher, then I'm going to pay a lot of attention. But lumber is just about at my price target if it hasn't already hit that 1575 for continuous lumber's futures price is to me like time to take it down, to be really careful. And if lumber is going to come down, we already saw Bitcoin come down and they trade identical. Let me show you that, guy, because I gotta show you a few things because I'm excited about them. All right, so this actually is, for example, all right, so lumber and Bitcoin. And we've been on this since like literally last August. This has been a phenomenal trade. So lumber and Bitcoin, if you know, Bitcoin, I've said for lack of understanding about its whole metaverse and universe, to me it has traded very much like a commodity. And then recently it has migrated completely into Ethereum. And you and I talked about Ethereum. You were really bullish at 1,000. It hit 3,400 today, and it's just still in accumulation. So this, however, is becoming a big divergence. So what's going to happen next with this commodity trade, right? Lumber, Bitcoin, and then are they rotating into oil, nat gas, gold, that kind of stuff? But tech is definitely getting hit. And value is still holding up beautifully. But here's the concern I have, and I'll just update this because I just did. This is still intonating higher. So this is that stock bond volatility ratio that I only show with clients and anyone who graces us with our, their presence in this particular webinar / interview. And for the podcast, they can't see this. So it would pay to go to the YouTube channel and check it out. But you can see this stock bond ratio, and I keep bringing this up, it's coiling, and this little gray thing under here, can you see? That's volatility. So we did have, today when I took this picture, when I closed my live trading room, we had volatility poke above this trend line, and I have to also note that this is an end of day. I can't help that, it's a ratio chart, and they don't do intraday. So there, but look at that. That's pretty cool. But we're still, it doesn't give me any confirmation until this puppy crosses above zero. In other words, for more than just a trade. Does that make sense?
Yes.
So it's brand spanking new.
Yep. Yep. Yep.
That's it. So my macro theory is watch the dollar yen as it relates to gold because they're inversely related. Watch the euro dollar pair trade as it relates to the dollar because they're also tied to the hip. And it's not really doing anything. I think we need another week. So bonds and yields are just, obviously not going to be very exciting for a little bit. I have very specific levels on that, but there's nothing to talk about until then. The market has been bid, and then all of a sudden it hit that air pocket on the open of 41.70 and just went swoosh. And then we're going to talk about what we saw. Hold on, let me just bring that up because it's really, really cool, I think anyway. Because I had this literally in my, this was also in my Slack channel, which was, that's the volatility trigger, 4170. Let me just put that here. All right, so April 19th, like for example, this is what I write for clients. So back here, currently, was it 19th, something like that? All right, so I think this is, we could currently hit 4170 and then have a nice 150 point pullback. And then the 29th, we definitely, volatility trigger is 4170. Can we see that? We hit it literally at the open. We went right down into support, which is this 41.33, and then bounced viciously because it's the 21 day. But once we break this level here, we have a nice pullback. And like I said, I think from peak to trough, it's going to be about 150 points. So what are your options? I mean, option flow, you have started to see this, right? And every single time it gets dumped, there's this reflexive trade. Ooh, I'm still sharing. There's still this reflexive trade that comes in and saves it. So algos kick in or something. And now we're doing a V shape off of that level. You got to move fast in this market. It's just not.
Still buy side So it's buy the dip, right? To an extent, because everybody's long in life and long in the market, right? For the most part, institutional side. So the short side is still not primed, ready, right? To stick per se, right? So the levels are not getting, it's not sticking in the sense that, okay, buy. So you get the drop, you get 50 points, you get 2%. It's quick, it's thin, it's quick, happens, and then it's purchased. Like the Dow Jones this morning, right? I was short the Dow, right, from last night. Futures drops, don't overstay your welcome, finishes back in the gap fill on that fair value gap overnight, because until there's some structure level breaks where they'll flip and all the distribution is done, right? This looks very distributive, because you're seeing the change in the actual behavior patterns of the trades. And that's where I would say, like, I could start looking at just showing some stuff, because
but I'm curious about the Dow, because I look at the SPY and I see SPX obviously tagged, right, the 21 day, but it didn't come back in. Like the Qs broke already, like, and that's a gap down, and it's a serious one. And yes, we're bouncing. This happens to be the 55 day.
Each index's components start to eat themselves. So like the Q's components are already much sicker than the DIA's components in the IWM. IWM is sicker than the SPX. SPX and DIA, as the composition of their parts, are a little bit still healthier than the insides of QQQ and IWM. And that's, to me, the natural situation that we're seeing. So the internals on these are really playing into how much and that ties back to advanced decline, some other readings you have, where you would say, okay, the Dow Jones is literally, because it's only 30, and those 30 are like concentrated in a lot of the things that are still safety, like in favor.
Yes,
that is
IBM, etc.
100%. Yep. Yeah, which I think at some point becomes like the widowmaker trade, because it's all concentrated, it's all the same, and when it busts, it'll get cracked very, very hard. Right, Qs, you've already seen it; it's already unhealthy.
But look look at value. I mean, it's still trying to break out. Value meaning, it's the closest, if you will, to the small caps. Relatively speaking, we're just sideways with this, IWM, the Russell. Value is still pretty bid. It's a little red today, but compared to momentum, which is down bigly, I mean, it's such a concentrated sell in the ETFs, which are Bitcoin related proxies, right? They've just rallied into resistance and failed. Solar, which is taking out, this, 9 weeks of sideways, et cetera, et cetera. And biotech coming right back in, ARC coming right back in. But big picture, we're literally 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This is 10 weeks of sideways if you look at it big picture, because this is a weekly, that's a daily, and that's an intraday. So I'm curious, when you say the diamonds, they're the strongest, no question.
Starting to see the underlying volume and underlying flow from a money standpoint go the opposite direction. I'm starting to see that. And then you can see the options start. I haven't seen that at all. Like here, I'll share.
Yeah, you go. Sorry, I don't know why it doesn't do it automatically, but there and there.
Like, let's look at DIA, for example.
Mm-hmm.
You see this? It peaked out, like the flows.
Okay, yep.
Right, flows from a velocity. So volume, like transactional volume and money, peaked out back in the first part of April. Steady sideways action with this being distributive. Even the larger size trades have gone net neutral to bearish. So on the sell side flipping, so the blocks. And the momentum has still been there from bid side. This is just looking at it from a sheer price perspective, from chart perspective. So it's still hanging out, right? But the components of it are really driving that to me, versus when you look at the Q. So like when you look at this versus the Q side, right? Qs are already negative, right?
Yeah.
Flows have already broke negative. And when that flow breaks negative, then it's all net sell side. And then you've got the momentum's broke the 50 marker, and it's broken down. That's why I saw this yesterday. I was like, this looks sick. And I wrote that last night. Q's looked unhealthy. I mean, it's got a big hold marker at this 312 level. That's a big hold area, because you can see I really don't have anything. This has gotten, so everything's kind of caught up to itself up here at the higher levels for the Qs. So the way we track momentum in the charts and the volume and velocity of everything, everything's sitting underneath it. So it's all setting for some sort of big test around 310, 312.
I have to show you this real quick. Let me just grab this, because your methodology of, 310, 312 that you just went through, I'm religious about this, and about very little, but about this. This is the 30-week, this dotted line, and every stock has a particular, kind of like relationship with a moving average on a weekly that I have found. 10-week for me is it stays in trend. It's your friend. But check this out. This is your 312 right here. And by the time it gets there, it's probably going to, flatten out a little bit and probably start to curve down. But we are aligned. I mean, it's just funny how that 30-week, I would say, keep an eye on it for Qs. It is like a magnet.
Yeah, and it's literally, these are all market structure gaps that were left behind, right? And when you're really looking out like that, if that were to go, then the 300 level. What's interesting to me is, like, when you look at like IWM, this is like, this is not a good, this isn't a good look. This isn't a good look right here. Like, this peak, this came back hot. This is about, a week ago when we were talking, this was positive. And then the last few days, this has gone negative. Like, the flows have gone negative and the momentum just failed. That's a big fail area. Like, it couldn't get back up here and break that high. That becomes very distributive. So now we've gone nowhere in 1, 2, 3 months. And the small caps, while the insides of this, so it's like the leadership, and you could see how much volume distribution is now taking place up here in the top part of this node, whereas there was very little volume back in here from November. So we've done nothing but distribute up here. From a market structure standpoint, price needs to get back above 230 and then go, and then you'll see more money come in. But right now, it's here to the sidelines. And then you could see all last week when you were looking at the options environment, when you were looking at the actual, let's look at this IWM. IWM's been red for days, days now.
So we have to parse this, though. I love that particular image because that matters, right? It is an absolute tell for where there's weakness. But I have to ask you, because we're talking 2,000 components here. At one point, the casinos were the most heavily weighted sector inside small caps. Now, right now, energy is strong, transports are strong. There's a lot of safety stuff that's strong. Biotech and, GME. Does that still have a lot of weighting? No. Okay, that's in retail. It does.
Yeah, it's still pretty solid. None of these in here, because there's 2,000 components, drive, right? But this GameStop is in the top, 1, 2, 3, 4, 5, 6, 7, top 8.
Yep.
Right.
Okay, so I wanted to find out because that could be a tell that casinos are starting to look pretty toppy, but there are some sectors underneath that look like they could be very much bid. It's to be determined. Again, that whole oil trade for me, that energy rotation, it's been sideways and looks like it wants to break higher, but that all depends. And right now, if the euro continues to move higher and push the dollar down, I think it will be an absolute trade for energy, and crude will break that 68 high, and that'll be trouble. That'll actually turn into strength in XLE and related components, but a headwind for the market. So we'll see what happens. But yeah, now
you look at the insides of IWM.
Yep.
Right. And so individual stock level, top 50 or so for the actual options market. Right. And so where are they sitting? Right. And these are green, technically still green. You dig into GME, it's starting to shade. Right. It's starting to shade where you dig into the second level and you're like, okay, how are these dominant contracts looking now? And I have seen this begin to change on the individual level. So as a whole, you only see in the top 50, 60 here, based on what it can fit in the imagery, for this particular view. But then you dig into some of these I look at this, I call it the Wall Street Bets Index I have.
Okay.
This right here, I mean, this doesn't look good at all. Like
That's a
you
lot
look
of
at,
EV plays, right? And the
yeah,
alternative.
you look at plug, you look at overstock, you look at fuel cell. These are awful looking charts. That's an awful looking chart, and I've seen a lot of these begin to shape. Look at Workhorse, like, you know, and this stuff was the stuff that we saw this effect take place where the options gamma plays a huge role now, right? Like with everything that we see. So the options gamma, you know, call side, right, sell, underside purchase, dealers, securities rise, they become larger in market cap. Larger market cap means they become larger in the actual indexation, right? Well, now these things have gotten smacked down since February, and they're not coming back. And that's now got this inverse effect related to the market caps, right? So you look at GME, AMC, some of this stuff, even when you look at, like, you look at PayPal's not in the IWM situation, but PayPal's in that crypto situation.
I was going to say, but you
right?
also have to show the crypto continue.
Oh, 100%. But like
the MicroStrategy, the Bitcoin Trust, the Mara, the Riot, the PayPal, the Square, they have and who else? Well, I'm missing a few. Visa? I don't even know.
Look at Fastly. Like all these things, DraftKings. I mean, these are charts that look, they're all the flows are negative. I could go on like this whole tangent, right? Like to just chart storm, right? All the flows, underlying flows are negative. And the options, right? Because everybody's gotten used to trading options. The options are not net negative yet. And I have 3 different readings on options. I got actually a 0 to 1 PC. And this is just our sauce because of what we've seen, because there's so much more options traded versus the normal CBOE distribution for like put calls, like 1 being bearish, right? 1 to 1.5 is neutral for me because it fluctuates in there nowadays. 1.5 on, that's bearish. 0 to 1 is bullish. You look at this overall and that's still pretty bullish, but you look inside of there, right? It's not the same. This is starting to turn, right? And so the undersides of all these things, the last thing kind of holding them up is starting to pivot. I think that's very notable. And you can go look at the underlying security flows are negative for most. The impact that they have on the index, it's just like holding itself up. So it's like getting this inbound activity from a passive flows right into these indexes. But realistically, you're not getting these other elements that they had for quite some time. And that started changing about a week ago. And don't know if it's going to stick. I don't know if it's going to stick. It can always change, right? The markets there's nothing static. But then you go look at the cryptos. Well, I look at the precious metals, like I'll look at those in a second. But I look at the crypto stuff, and this is the stuff that I posted last night, right? With the crypto piece, you look at Mara, right? This doesn't look good. Look at the flows, right? Peaked out.
Oh,
right?
I'm bearish. Trust me. This to me, I agree with you.
Riot peaked out flows. Overstock, which got a big bump because of that, it's still hanging on, right? A little. Square, that doesn't look good. That doesn't look good, right? That's turning back. These things take time to develop, but it sure looks like we ran out of gas after February, right? It really does look like we ran out of gas across the board, and we've been distributing up here. And I could say the same thing across the board. And what I am seeing too is when I look at the VIX itself, the VIX this has changed. So if I'm looking at the look at that. That's the great whites, right? SPX, MDX, RET, Dow Jones, VIX is the green, right? And that hasn't manifested itself truly in a change yet, trajectory, but it's always under the surface that this stuff changes before the price realization comes to fruition. So all the underlying security flows have started to go net negative. The passive indexation seems to be holding up. Plus, the single stocks are on the verge of flipping. I haven't seen that yet, right? Like in a big context, like as overall. So let's top 50 equities. Today you started to see these change, but the single stocks, if I look at the single stocks themselves versus the indexes I haven't seen yellow on here in 2 months.
Okay.
and it's starting to like shift a little bit. These are individual names. If this starts to really start to change over the next couple of weeks, very substantive, because that means that that options effect, which we talked about extendedly for a long time, it doesn't go away. It just flips, right? And it could flip on the whole situation, which then options, that ties right back to the VIX.
Explain
Gamma,
that a little bit.
the gamma effect.
Okay.
Gamma doesn't go anywhere.
Selling
right?
begets selling, the more negative it becomes.
Correct. Yeah. So to me, when I look at the charts and I see this, this is every block. Like block is a pretty balanced. Look at the flows, negative and struggling, right? Struggling. And then I look at the stuff for like I haven't really looked at. I mean, it seems to be kind of a pervasive thing.
Oh,
that,
I think that's a beautiful short EEM, but that is completely contrary to the. I mean, that's a dollar move.
This seems to be the Dow Jones. Those value plays seem to be the bastion of the last hope here, right? Holding this thing together to an extent, because the rest of it has fallen apart, and that indexation situation, right, is being held on solely because of the passive flows at this point. So I think that we're closer than we are far away from being really tested.
Oh, and I mean, we're closer than further. Yeah, I'll worry.
To being really tested, and tested is okay. All that liquidity, everything else. I hear you. You got major inflation. I hear you. Okay, what about like market structure to be tested in a passive environment? Because when we were tested prior, right, in the election, that wasn't really tested. That was like a different situation. This is, people aren't spending the money that they were, right, in the markets. They're starting to spend money in real life. And so are they gonna like step in here, right, with this, right? Or I'm very curious to see how this shakes out. I've been on the sidelines from this for quite some time because it needed to shake out, and you see how far this thing goes. But I'm beginning to see, and that's why I was vocal about it last night, I'm beginning to see my stuff that I track regularly begin to deteriorate. And I'm trying to be notable of that the options market is beginning to, I'm seeing single stock change, right? Where it's shifting from all call side, heavy call side, right, to mostly call side, to now it's like neutral in some single names. And that's noteworthy because of how big some of these single names have gotten. So those are my points, like kind of across the board, the way I look at it. And these market structure levels are so extended, right, for all these names that, I mean, they got a lot of room to chase. So, this can go on forever, but it can't go on forever because nothing goes on forever. So are we approaching some sort of test? I don't think it's an immediate situation where it just changes overnight, but we go back to the way that this thing is all set up. There's tons of tail risk. Tons and tons of tail risk. That's all I can say. And one thing I would say too is like your stuff is starting here. Let me share this again. Like, we've talked about how like really like the volatility stuff. Like it's been kind of like, it's been like, is it negative? Is it positive? Is negative? Is it positive? It's really sitting there. Volatility hasn't gone anywhere in about a month. It's pretty static. And so it's flirting with what it's deciding to do. And now I'm beginning to see that stuff, the curve structure and the volatilities change, right? And so now they're going to get, bearish, right? For the market's bullish for volatility to an extent. Now it hasn't totally triggered 100%, but I'm seeing this, like you could see like these things, let me jump over to.
It took a month, you're right, for the Qs to take out their lows. 1 month.
A month.
Today. In other words, in the past month, we finally took out the lows this morning when we opened.
Like these things have been like killer in the sense that I call them jaws. These are big jaws plays, right? Like the way you set these up, these are jaws plays where they reconnect. They may get extended from themselves, but they end up reconnecting, and they reconnecting violently. And I could see that across the board with this stuff as I've been checking in with it the last couple of weeks. And so I really think that we are approaching, like, look at all this is very good. It's on neutral.
And
right?
Just
in a bigger time frame.
That's more of that's a daily factor. It doesn't do intraday.
Yep.
Except for one check at noon kind of thing. But the point is, it's supposed to be for those who are not looking intraday. They just want to know if they have anything they have to worry about when they check in after work. And
right.
they see, okay, did anything trigger bearish? Yes, stocks did, for example. A portfolio is not triggering yet because we still have not broken down in SPX, but we have in long ago in treasuries. But
Yep.
yeah, so this is what was I going to say on the okay, let me just show something which is kind of interesting. And again, it's geeky, but it's kind of how I work, and it doesn't work for many, but I'm going to do it anyway. Um, and you know what? I don't even have any of this in these algos. Maybe I should think about that for sure. But first, Thomas is asking on that bubble chart where Tesla and Amazon stood out, what does their yellow respective green mean? RESP? Yellow, what's RESP green mean?
Yeah, yellow is like kind of gives you an idea of if the overall put call like balance
He's
is net
asking
neutral.
if it's
Yep.
delta for open interest or dealer gamma, and you're saying
Oh no, that's PC. We're talking about gamma and we're talking about delta, but we're not those charts are not those aren't gamma measurements. Those are raw options data calculations, right? So those are showing you the actual balance of it, not like gamma exposure. We've got gamma exposures in a separate section.
okay. So what I wanted to show was kind of a tell though, which is interesting, and I don't know where it's going to go right this minute, but this is just a screen capture that I grabbed earlier, and oops, let me just show this one first. So this is, there we go. This is the diamonds, right? And so price looks pretty firm. It's just kind of like flatlined here, and yet my indicator has already done the curve, right? So that means there's a divergence, and it hasn't fallen yet. This clearly has, and you can kind of see also for those who do stochastics, we definitely have broken down below the 80, which is bearish, and yet price is holding up, right? Now go to small caps. You have this double top, which is, you know, a sign that we do have weakness potentially coming in, but price still hasn't triggered to the downside. Then you go to the Qs and see where this top is right here. I've highlighted that whole section where we went sideways and then boom, we were down 2.5%, 3%. So in a New York minute, we basically opened up, gap down below pivot, but this is where it's kind of been indicating that something was up. And the same thing with SPX. Here we have this kind of turn up here, and then all of a sudden we started moving. So this, for me anyway, definitely shows some weakness coming into the market that was kind of, like you said, for the risk indicators, kind of smelled that something wrong coming in, and then just recently, let me just grab that as well. Am I still sharing or no? Probably not.
No.
Okay. I will. I'm still on app. Okay. So, give me a second. All right. So if I just sort here, when I took this morning, there were only 3 that had triggered bearish, right at the open. I'm trying to find exactly what they, and this is the intraday. But I want to just show it because it was interesting in that, oh, I cut it off. Dang it. Oh, here it is. That's it. This morning it was the Qs, SOX, and XLK. And if I tag this, chart to see where they actually turned, they had turned a few days ago. So, in other words, this turned bearish and then continued bearish, despite all of this price action in blue. The indicator is like, nope, stay short, something's wrong. And that's kind of the same thing that I used and just showed with the Copic curve, which isn't even part of my indicators, right? There are lots of ways to get at the same thing. Your option flow, you can see with that chart that you showed down at the bottom panel, the weakness that's coming in. You can also see with the optionality with the puts that are coming in. So we're all kind of converging, if we will, these tools that say, okay, this algo says short, my intermarket says short, your option view says short. Okay, so now what?
Yeah, so what I would say is you don't know yet because it's still got the buy side, right, that we saw with the Dow Jones today, right? Because people are still getting long. And so people are still going to be soaking it up until I think that what we haven't seen in some time, where if there's a real top, like when you go back, is there a real top, right? The real top is when it's really deteriorated and prices continuing to just be in total denial. We've seen deterioration, but it's continued deterioration. If it takes another stab higher, or these things bounce a little bit and it continues to deteriorate and volatility continues to start to surface, I'm in. I'm all about it. Like, I think it's time to see what this market's got, and far as like strength and bid, and where those bids reside. Because I think a lot of the stuff hasn't come back. Like a lot of that fuel cell, that Momo stuff, that stuff hasn't come back. And Bitcoin stuff, that stuff is, institutions had their moment to get exposed, and that stuff's not looking too good for the crypto related stocks.
That looks like Bitcoin could take another drive down to like 40,000.
Ethereum, I think, is on its own because it's being used for bond undersides of bonds, like with the euro is writing bonds on it and things like that. There's a lot of use case.
2.0, right? So folks are all excited about the faster and cheaper and all that.
Yeah, I mean, there's tons of use case discussion in that, but like to me, they've bifurcated, because now you're talking about one with a different use case than the other.
Yeah.
And one's got a more permanent use case than the other, in my opinion. So like, that plays in. So just take the securities stuff. When you look at the securities themselves, that are under the surface and they're starting to deteriorate. At what point, like, you get the VIX has to shake for a minute, and then you got to continue to see the underlying deterioration, while the passive indexation continues to float it, and then it just collapses on itself, on the weight of itself, and then we see these market structure levels that were all left behind. We have so many levels that have been left behind in the last 8 months. I mean.
Here's the best one, and it scares the bejesus out of me. You got to see this one. Hold on. So this is actually important because I am a reflationista. I mean, I have been with this growth to value rotation theme strongly in every dip, right? And every peak and every dip and every peak, I have just been on this. So to see this particular chart. And this happens to be SML, which is the top 600 of the 2000, okay? But institutions really like this. This is not an optionable instrument, but you can actually trade the stock. I mean, how big is this? This gap. You could drive a truck through that. I mean, I've just never seen such a thing.
Go to 1100. Go to 950.
It's not like there aren't more. There's
750.
There's more. There's more. There's more. But that's a big one. So I'm watching this one like a hawk as this starts to flatten, right? And maybe this is a left shoulder ahead or right shoulder, but it's way too early, and I don't want to play that game because it really has to break down. But I like charting stuff that isn't traded. Heavily. I like charting SML. I like charting NYSE, right? So these to me are just also relative to SPY. It has definitely been coming down. But commodities are still bid. Lumber, corn, Bitcoin, and now Ethereum. It's been impressive.
Yeah, I think the gold charts, the precious metals don't look like that. Like the flows are actually coming in.
I'm confused.
So I'm wondering if like there's some play with banks right here and solvency overall related to currency.
I don't know if it's solvency or the fact that they have so much money and they're telling clients to go put it in mutual funds. And then there's this little
solvency, the wrong word. Currency structure problem, something to that effect for sure.
This is it. This is it for banks in a nutshell, and it might be a little bit early, but I want to show this because it's the only thing I tweeted today. I've been really busy. The 4 largest U.S. banks, you know them, show deposits grew by 15% as of March 31st. Yay! But their combined loan holdings fell 10%. So now their loans to deposit ratio sits at 61.5% for all banks in the U.S., the lowest ratio in 48 years. That's like, they're not lending.
They're not lending. They're not lending, but it's a function
of hoarding. And the SLR requirements and that whole crowding out That Barton Wang talked about like a month ago that was going to be coming up toward the end of May. It was going to become an issue toward the end of May. Maybe they're just kind of front running it.
You know,
I don't know.
I don't know. I don't know. I don't think, it's very hard to guess at any of that. Like, I just look again anecdotally. So like talking to somebody this afternoon, I was like, somebody I know, business guy, sharp young guy. He's got a couple businesses and he's looking to grow. He's got one location, great location, done very well. And he's like, I want to get a second one. I was like, that's good. I said, how's it going? He's like, terrible. And I said, why? And I was like, you're making money. You got, your free cash flow is looking good. You got a scalable model. He goes, I can't get a location. Physically can't get a location. He's like, no, there's not enough available.
Oh, low
And then
inventory. I've heard that from real estate
so
agents.
there's no locations. And then there's like, so he can't even get a commercial location anywhere.
Yeah.
And then, so like he can't actually go borrow because he can't actually go do anything because there's nothing available.
So it's really funny. It's
these
like
are
a catch-22.
Paradox, right? It's a total paradox.
Those
like
who
where
want loans can't get them. Those who want employees can't find them. Those who want real estate, well, it doesn't exist right now. The inventories are so low. Real estate agents, they think they're doing gangbusters, but they need more inventory to actually sell to make the commissions.
which it won't happen. It's an era of paradox because the mechanism when the fiscal came in.
Yeah, and the PPP loans.
The guy that made the comment about banks, when banks won't loan, that's why it can't be hyperinflation. I totally disagree because that's not how it works. Like what they did is they circumvented the banks and they just gave it directly to everybody. Right? And people literally have flooded the system. Right. And then assets have gone significantly higher. Well, the savings rate went up significantly, but then there's some mathematical statistics that show that a lot of it, because it capped out, then a lot of it went to the market. Right. And so, so the banks are fine from a savings perspective. People are fine, but then it went to the market. So the market has had asset inflation. Right. And you've got the people in the real everyday world where all the goods and services are being chased by a massive amount of money. And then, the other people are being paid to not work. So you've got a whole age of paradox, right? Where some of these models just simply don't work, which goes back to your macro that broke it. I don't disagree. Some of this stuff is just totally, when they made that decision because they haven't done that historically. They always done the banking lever. And we've talked about this a million times. They'd always done the banking lever and the fiscal lever and alternated those things. They never hard pressed both and then totally gangbusters pressed the fiscal, just pressed big time that button. And that went directly into people's pockets and it was inflationary.
So we have still work to be done there on the inflationary. We're doing a lot of catch up. So, I don't want to get ahead of myself here. When I say that I believe this is obviously we're in an inflationary cycle, I don't know if it's secular. It is because there's just too much money chasing too few goods. And I can see commodities, making highs after multi-decade lows. So as far as I'm concerned, it's still a catch-up trade. We are still historically
100%.
low in rates, historically low in commodities, even though people are like, they're up 1,000%. It doesn't matter. It's historically we were on the bottom. We had negative oil. So it's all in context, span a little bit bigger lens and it doesn't look so overheated. It looks like it's just finally coming back or trying to come back to the mean. But the one thing that I would say, and I really highly recommend, was a podcast that I listened to this weekend with Judy Schell. And she talks about how stimulus is actually, we would be a lot better off if we hadn't had stimulus. And do you know who I'm referring to, Judy Schell?
Mm-mm.
All right, hold on. This is, she was, under Trump anyway, nominated for a Fed seat, and she didn't make
Shelton.
it. Shelton.
Sorry.
Sorry.
Yeah.
I recommend this because I thought I loved, what the heck is her name? I mean, it is Shelton. Okay. I'm embarrassed now because I was very excited. She followed me back. Okay, so here it is.
Yeah. She's a gold standard.
Yes,
book.
so a lot of people gave her so much grief because of the gold standard. And I would just absolutely love to find that link because I thought it was brilliant. I posted it for clients this weekend. Um, and just, it's Daniel, hold on, almost there. Okay, here it is. Love this interview. I don't think there's anything she said that you would go, oh my God, she's out of her mind. That connects. So anyway, the U.S. recovery would be stronger without stimulus, and she details why. And I thought it was absolutely worth listening to. Highly, highly recommend this. I can't believe I only got 4 likes and 2 retweets. It's so good.
It's not like nobody was wanting to hear it.
It's so good.
But Griffin interestingly enough, Ken Griffin said the same thing. And he said it like probably a month and a half ago in the Financial Times. A different way he said it, but he said, the issue now is that we did things that we can't take back, right? And we've stimulated in a way we can't unstimulate it, right? Because it went fiscal. And so the reaction was just over the top. The danger now is runaway inflation. That has to garner a strong, swift, and sudden reaction that is really not prepared. Market participants are not prepared.
She doesn't talk about the hyperinflation. She actually talks about how cryptocurrencies are stepping in to help mitigate that because people are afraid. No, I don't want to paraphrase. Listen to it. It talks about the whole crypto thing too and how that has a place. What Fed head would ever say crypto has a place? She actually comes out and kind of supports it. So
crypto?
Yes.
The coins.
The Bitcoin, the whole just why it has become as powerful as it has, and in navigating its role in monetary, future, basically. So it's one of those things where you don't usually expect that kind of conversation, and but definitely not for hyperinflation. That's not a theme that I'm getting anywhere except for that Michael.
What is the definition of hyperinflation? I'm curious, like your perspective on this. Like I see houses that were,
what do you want, Stella?
400 to 500,000 for like, I don't know, 10 years. They go up to, it's dinner time. It's like clockwork. So it's let's say that are now 1.5 in 8 to 12 months.
What?
Oh, everywhere. Some going for as high as 2 million. Like $400,000, $500,000 houses. Like with in certain areas of Florida where they got like a car in the driveway that's been there 4 years.
Yeah,
it'll sell instantaneously. In Miami, stuff's lasting days. Like I kind of got a hard time buying pin-up demand, right? Right. It's not a pin-up demand thing. It's in such a short period of time. And then you look at the used car prices. You look at anything that's like a physical product.
I loved that. A guy brought his Carvana car back after 2 years and got the same price for it.
Simply unheard of stuff. And so you're starting to see grocery stuff that's packaged goods go up 25%, right? And so what is the inflationary breakpoint where like we want inflation, we don't measure it? Because if you measured housing inflation right now, how do they measure it? Do they measure the payment or do they measure the cost of the property? Right? I'm not sure what that is because if you look at it, I have never looked at the CPI statistics to determine it, but like the payment can be mitigated to an extent by the interest rate and the amortization schedule. But if you look to the physical cost of the property, the outright physical cost, then it would be just massively higher. Commodity. This feels a lot like, where it's paradoxical in the sense of the 70s where things were just really trying to sort themselves out as related to geopolitical finance structures, as where we're doing all these things where it's super experimentation. I'm curious about the hyperinflation thing because what is the definition of hyperinflation? Like to us, is it where a house that was 500,000 is now 3 million and that's the going rate? And then 12 to 18 months that happened? Is the argument that that's healthy? I'm trying to wrap my head around that. Crypto coins like Dogecoin, There's nothing about
Wait a
Dogecoin
minute.
that's
I got
healthy,
a client who texted
right?
me, who shared in member chat that Dogecoin is now being accepted by the Major League Baseball. Which outfit? Marlins? No. Hold on.
The Dallas Mavericks and the NBA have taken it, and then a couple others, right?
Blue Jays. Funny, huh? Literally.
Yeah, they're taking it because, like, why not? I mean, they're not stupid in the sense that if I got $10 million
100
in
Dogecoin
Dogecoin,
for a season ticket. And that makes no sense to me because it's like $42.
and look, I'm all for technology, I'm all for everything, but what are we doing here, right?
Playing. It's all speculative. I have to show you something though regarding, I don't know about the hyperinflation thing because we haven't had it and likely.
What is hyperinflation? That was my question. Like, what is the price point on things that we just say that would do? Yeah, we're dealing with hyperinflation.
I think crude above 68 can take off the way lumber has, and that's going to be
Is a $16 2x4, right, and $118 piece of plywood that was $30 last year? That's not hyperinflation. That's not inflation. Is that just natural? But it was pent up demand.
Yeah, yes. I mean, honestly, don't know the answer if you want a definition of hyperinflation or as it relates to our secular ramp up right now in commodities, which I can see this is like literally multi-decade lows, right? This is negative oil and CRB, by the way, on a monthly, just to show you kind of what I'm looking at. So basically, we're coming right up to this trend line, which, by the way, this is when we had 140 oil. That wasn't hyperinflation, right? And that was solid deflation. We have been in a solid deflationary trend for 40 years. It's not changing, and I don't think it's going to change with technology and and demographics and the rest and interest rates. We can't let them go higher. We need, I think they want some inflation. They want definitely some taxation and to help this speculation get muted. But I don't see anything right now at risk of really taking off and scaring the market until we get above this trend line. So I'm not answering your question because I don't know.
I'm looking for like how we would classify a society that we have runaway inflation.
Bonds collapse. Because then they're going to have to hike and hike and hike and hike and hike so much. And then you know what happens to pensions.
So do we change the way we read everything so that doesn't happen, and change the way that the bonds are measured so it doesn't happen?
I don't know. Yellen says we need higher rates.
They're not doing anything, but they're saying a lot of things, right? But like,
I'm making funny faces. I didn't realize the screen was still being shared. Like, but Yellen says we need higher rates.
And I'm not asking. This is just like me saying, it's like, okay, we don't have inflation. All right. Okay, what is it then?
It's like 12 or 13% by any means that
by definition.
By definition, that actually includes the things that matter: healthcare and tuition and food and actual things. But it doesn't matter.
University tuition went up at the university here in the state, I think 20%.
What this year?
Mm-hmm.
That makes
it was a huge shoot. I've talked to people like everything.
Okay, that's
so I'm just sitting there. I'm like, well, what is?
Because I would think that colleges would be a great short if there was a vehicle to short them, just because of demographics alone. Like my daughter went in at the height of the demographic, mood, and now, of course, we have a completely different, I don't know, cultural shift of you don't need a degree and it costs too much money and you can do it remotely. Why pay the $64,000 or whatever the heck it is at Harvard? So if there a vehicle to short colleges, I would think that'd be a really viable one, but it's unheard of to actually increase tuition.
I'm just like kind of sitting here, and every single thing is like up exponentially in the last 12 months.
Yep.
And at what point and so it's like one of those things where it's like, I'm not going to acknowledge it. It's not there. I'm not going to acknowledge it. It's not there. I'm not acknowledging it. It's not there. And it's like, dude, that's like, the elephant is like literally right here in the room. And it's like, okay, we got to deal with the elephant, but you said there wasn't any elephant. And so what is the move that can be taken? And I think that, and I keep saying this and saying this and saying this because it goes back to, I just go back to what Griffin had said. It says the biggest risk in the room, because which is just runaway inflation.
Okay.
Where it's in total denial. Like it's denied, and then we have to take action. Because if we don't take action,
well, isn't that the whole underpinning of the Fed mistrust and why Bitcoin has had such a platform, is because they don't trust that the Fed actually knows what's going on or will react in a timely manner to head it off. And then when they start reacting, it'll be fast and furiously and too little too late.
I don't think that's a sound, like, I think maybe that's a sound like thesis, like a why they're doing it as a narrative. But, I go back to not Mark Figg, but Jim Rogers interview I listened to a while back. He's always very funny. He goes, he's like, I've been through the government stuff all over the world. And he's like, they just outlaw it at the end of the day. Right. And they go, no, you can't have it. and like, he goes, because they got the guns and you don't have the guns. They got the tanks and the militaries and everything else. And like, I think that, like, in a perfect world, right? In a perfect world, that's a very definitive and functional narrative. But in like the real world, right? Like, I don't think that's a fair and equitable thing. Like, and Bitcoin people would say, oh, you can take it anywhere and just plug it in over here and what have you. But like, if push comes to shove, things get really out of hand. Would that be realistic? Would there be some sort of significant problem with that? Well, not as mainstream adoption. That's a complex narrative or a paradoxical thought, because as mainstream adoption rises, then the securities and inspection and analyzation of those holdings as it relates to, the reporting of them, the anonymity disappears. So the anonymity that you're claiming is the narrative that drives your adoption of it is actually inverted when you get mainstream adoption of it, right? So then the whole thing about it being anti-Fed is actually not right, because it's actually anything that comes into the Treasury system, the governmental system, the IRS system is now property rights. It's documented and the government's get involved. So I go back to, I don't have an answer for that. My big question is runaway inflation. What's the move? Because I wonder this all the time myself.
Hold on to your hats.
Is that it? Hold on to your hats? Like
yeah. Make sure you have some real estate.
But they can property tax you. They can just increase your property taxes.
Yes, they can, but they can also go into your bank vault and remove your gold. I mean, they honestly have the right.
I'm not sitting over here saying we should go get a bunch of gold. I'm not saying we should get a bunch of gold. I'm not over here like, Okay,
I was gonna say next you're gonna tell me you're a silver bug.
No. I'm actually just a questioner. Like, I'm just questioning like the situation, because I feel like the fiscal response and the fact that, we fiscally responded to a shutdown that was short term compared to the response, right? So it was an overreaction to a period that didn't last as long as expected. So they duplicated the reaction or tripled the reaction to the actual economic impact, then stood up the bonds, then stood up the companies, right? And so you did a fiscal transaction, and then you stood up all the companies like Carnival and the rest of these airlines and everything else, right? And so the amount of liquidity that now is floating around is almost like, no, it's not there. No, you're not. No, it's not there. You're just not seeing it. Stop, right? It's not there, right? It is there, and that's the risk. Is that risk doesn't go away, it just transmutes, right? It goes into a different structure, and so risk never leaves. I think that's my biggest question is like, okay, so how do you think about the real risk now that is surfacing in this as this has gotten away? And that's my deep question I've been thinking about. Yeah, we get on here and I talk about stuff all the time, things I and looking at what have you. I'm very wide open about things I don't fully grasp or haven't solved myself or anything like that. I really think that this is the biggest question I have. It's like, okay, right? $2.5 million house that was $500,000 12 months ago.
Mm-hmm.
Same house, right? No demand curve. Like, you can stop with all that because that's not it. Like, that's what? That's not pin up from and because the price of that house in 2006 was 250,000, went down to 125,000, and it's been on a steady rise since then, and it's recovered and it's doubled. So it's not starting at a place where we recovered it from the 2006 lows. I don't want to hear that either. This is 4 times, 5 times the price it was 12 to 18 months ago. Now what? Like, let's say we're about the wrong thing. CPI cannot even exceed 3%.
But
What's the measurement of CPI?
But they're actually expecting CPI to move higher to 3.5–4%. So maybe even by July.
It's trailing, right?
It's trailing. It's definitely a lagging.
And it's discounted. So they discount out the things you actually use in your life.
And they ignore it.
They don't even, it's just it's a garbage calculation.
They ignore it. It's like, why even bother?
So I have that question. So it's like, so I haven't got an answer yet. Like,
I think it's a brilliant question, but we're early innings, right? So when I look at that, the perfect storm that would continue to support home prices, which is low inventory. I mean, wicked low, right? By 1950s kind of low. And then you look at still historically low interest rates, and you look at the demographics of millennials with cash burning a hole in their pocket, or their boomer grandparents giving them money, because that was interesting. I saw a statistic where I think 24% of the money that they're getting to put down on these overinflated houses is actually coming from family. So they're supporting this. And then you've got 1 in 4 or 1 in 5 of suburban all houses are actually owned by publicly traded companies like BlackRock and such. So you got like a huge tailwind for higher. Then you add input costs like lumber, the inelasticity we've been talking about of lumber for bloody months. Like what, 6-7 months we've been talking about lumber. Yeah. This is not new. So, copper's going higher. Oil looks to be like just, even though it shouldn't, moving higher. I don't know. You have a really solid point. Maybe we are in a hyperinflationary period. We just don't know it yet, or we haven't acknowledged it yet because it's so bloody new. We haven't had it forever.
And it's not an incentive alignment. Everything tracks back to incentive alignment. It's fine. It's good. I'm good because I'm benefiting from it.
I know, but at the same time, the dollar's worth less and less and less.
Well, the gambit is that, right, which I see again.
And Ethereum
I don't have an answer.
And Bitcoin has ridiculously, high price. Even Raoul Powell is like, it's worth $1 million in the future or something. The point is, it's way too crystal ball foggy for me. But
all of our infrastructure isn't based on those things. Like I hear what he's saying too, right? But that's not how people buy houses. They buy them with a mortgage and an interest rate because they can't afford to buy a house, and they sure as hell can't afford to buy one now.
Not without help, and
they couldn't afford to buy one before. We're in a fractional society, right? I'm renting everything.
That's
right,
true.
effectively, right? So I'm going to stick on my stump. At what figure in the societal infrastructure are we going to say that we got inflation? Or does it just go, it was in denial the entire time. And then it looks back and it's like, oh, everything fell apart because of that. And I'm not, this is literally just a fireside chat with Jonathan right now. totally full of shit and just talking.
No,
So like, I apologize to everybody.
no, I love this. I haven't even thought about it. Oh my God, are we already gripped in hyperinflation? We didn't even realize it. I don't, I didn't even think about that. I'm still just locked on the inflationary definition of too much money chasing too few goods. And then I look underlying at the lumber, which is the processing costs are through the roof, but the actual pulp material is still rock bottom prices.
And
So
isn't the savings measurements total garbage? Because you say that like everybody's got all the savings. Well, you're measuring it when everybody had $200 in savings, and now they have $2,800 in savings from the money that was
that's a rate
fiscally
of
deposited.
change. Yes,
That's a fiscally deposited amount that you put in their pocket. And so that's literally, you took it from the money printer and you put it in the bank treasury, and then you measured it. Look, everybody's good. But in reality, right, the situation didn't change except for the prices went up in every way for that person with the $200 in their account. And so these are like so what is the net impact of that? That measurement, it's like the numbers, the way we look at analytics has to be assessed in this situation, right? Because I again, it's a simple question. Are we in hyperinflation? And is it just simply not in really anybody's interest to acknowledge it?
well, because no one's asked. They expect it in the future, some, but no one's actually thinking they're in it now. No one's talking. I mean, other than the speculative fervor in cryptos, Bitcoin, Ethereum, Doge, whatever the heck, the rest. Nobody's saying we're in hyperinflation that's going to cause a mini crash. But volatility reprices everything, and it definitely, pokes its head up and reminds us not to be complacent. But yeah, no, it doesn't slap us in the face and say we're in a hyperinflationary secular trend. All I can see right now, as far as I can see, are some resistance level coming up in commodities. My crystal ball is so short term. You're asking good questions.
These commodities, I think, in my perspective, your thesis to the commodities continue to run hotter, I'm all on board.
Because they're
I
a
think
hedge for inflation.
100%. And then the flip side of it, the equities are just now getting started to be repriced, because in a hyperinflationary environment, that's not. Do we have
bonds need to follow. No, they need to follow.
I'm with you. That is such a systemically important structure.
That's the math, though. It's dead. That's why we haven't talked about them, because they're dead.
That's got to be shook out of the tree. Right?
So right now, that's what I'm watching the most. Some currency action for sure. The bond action, it's been boring. I don't want to talk about it because it's really boring. But when it becomes exciting, we'll know it. And it'll smell, or it'll catch on, depending on how your hyperinflation read is.
I think the trading environment changes the back half of the year. It becomes a trader's market versus this passive thing. The active and passive transition hasn't even started yet. That's my only takeaway from the inflation, is that it's just going to usher in a whole bunch of unknown unknowns, which we then have market structure that's not really set up for that at the moment, with a lot of new players and a lot of new systems and a lot of new setups and a lot of new demographics and a lot of new people in the world to trade, et cetera, et cetera. So I think that like the back half of the year that we, in that transition from passive to active is about the only thing that I could say I think is pretty much a bet that you're going to continue to see that manifest itself with however this inflationary thing shakes out.
You know why it's active to passive? There's only one reason.
Go ahead.
Because value is actually an asset that matters again.
The statement I heard last night was
value. I'm talking about value, the anti-momentum trades versus growth. And
Here. So why would you go to that? So think of it this way.
Because the low volatility in those plays, they're just steady Freddy.
Free cash flow. So think about it like this. So this is Kim Carson. I hope I'm saying his name right. He's always got, it's just the way he pronounces different. So he said, when you look at that in an illiquid environment, being able to self-sustain off liquidity, i.e. free cash flow, becomes much more valuable.
Yes.
And I was like, man, that's a really good thought, because when you think about it, why would you rotate to value in the first place? Because they can self-sustain cash flow.
Oh my God,
And
that's Berkshire Hathaway in a nutshell.
yeah, yes. And in times of illiquidity, those who can self-sustain become worth more, right? And so why are we rotating to value when liquidity is bountiful and endless? If everything is fine, you should continually be bidding out the prospective growth in the future,
That's getting a huge, huge test right now, no question.
which is like why.
The Kathy Wood, theory, the Tesla theory, the I don't even know what it's too long a list.
It's totally understandable because in a zero interest rate environment, in a low cost of capital environment, in a free, capital is endless environment, then you're going to chase the greatest returns. Those greatest returns are always in innovative stuff because they reset the way we do things and they destruct existing things and then reestablish new things. So, what was a business is now not, and what is created is now the business. Therefore, all the value is transferred. That is highly happens in a low interest rate, highly liquid environment. Well, we couldn't be in a more liquid environment and a lower interest rate environment. Why are we losing these things? And rotating to free cash flow situation.
That's a really good. I'm gonna have to dig into that one a little bit more. This is okay, to be determined, but right now it's almost yeah, the cat left me, she gave up. But all right, this has been very thought-provoking. Hope you all liked it. We're gonna give me an update.
Probably never gonna come back.
No, I don't care. We do it for so many reasons. It is intellectually fun and challenging, and you always say something that I have to write down.
Because I'm always like just yammering, and you let me.
And I like to show my very nerdy little charts to say, what about this? Oh yeah, I think so. Now let's figure out if this is going to actually mean something, and then we've put it. It's a timestamp, so we can go look at it next time. Okay, so hyperinflationary environment is now. I'm not gonna put that. But I love the low cost of capital thesis. I think that has absolutely legs. Okay.
And it's an liquidity excess and an illiquidity conversation, right? Which makes total sense for free cash flow, which is like free cash flow hasn't been valuable in forever. Who cares? I can get nothing. I can just go get whatever I want and burn it in a trash can. I don't think that's fully lit yet because the VCs are still super flush. So as long as the venture firms are still super flush and the excess returns are coming from the markets, that means that those VCs are still flush. And so it's a paradox in the sense that as banks have salvaged and created excess returns, those excess returns go into VCs, which then eat the things.
Eat the things. Yep.
Right. And then that becomes what gets eaten. Well, what's getting eaten is some of the existing banking infrastructure. So you keep it alive too long, you risk your own demise. Right. And that is a true Ouroboros, right? Snake eating the tail paradox. Because if it remains cyclical, right, then you usher in crazy things.
I'm not a bank analyst, but I know that they have to start increasing that ratio that I referenced in regards to loans, because that's going to be a strike back moment. They have to do something with all that cash, and they have to help the economy grow. And right now, stimulus is a short-term high.
It's not a solution, because it doesn't create economic commerce. It just creates temporary payments.
It's not productive use of the money at all.
It's drugs, right? It's like giving you something for the pain. So because it doesn't do anything for the long term. I think that interesting to your point, and I have thought about this, and just now I'm like connecting the dots. The value conversation for some time. Then you throw in that free cash flow thing, and there's less companies producing free cash flow. An environment that becomes illiquid, don't those companies become worth even more than they would in a normal environment because there's less of them? And then on top of that, small and mid-sized businesses that actually are producing free cash flow in a world where most of the businesses have become tech-driven dumpster fires for cash. Aren't they worth more money when money becomes illiquid? So, I'm curious, that could play into that value conversation where the value companies become even more valuable, which is totally crazy because they're actually in a bull, and they never actually even turn over at all as things just get incinerated on this side. It could be totally because we have done something we've never done, which is to dynamically stimulate.
But it's also I was going to say something we've never done, which is actually, in this administration, to care about the real economy. So maybe this stimulus isn't really a productive use of money, but it's trying to get into at least the hands of the consumers, and potentially the zombie companies can, I don't know, emerge from the dead.
The thing I wonder is the highly leveraged, right? Like the highly leveraged stuff, it's fine as long as you can continue to roll debt, and then the counterparty holding the debt. It's not in their interest to roll you right the wrong way, because then they're stuck with a bag, right? So that's all that senior loan stuff. I was looking at BKLN and it's gone nowhere. Closed lower than it's open for like 4 months now every day, and it can't get any more traction into that stuff. I haven't dug through.
I don't even look at them anymore because they're not representative of the credit markets anyway.
Well, there's no credit market because they're not lending,
and it's also there's no credit market because they're not lending. It doesn't pay to look at that. The ETFs, they're also highly subsidized by the Fed.
To an extent, too. A lot of that is held up to your point of the oil and gas space. So there's a significant portion of that that's oil and gas which has been remedied, right? So I don't know. This is super like New Frontier, Vanguard, like gotta have the ability to swivel a little bit and kind of keep your eyes open, because like I think that we're dealing with a lot of different dynamics. And I sit there and I'm like, all right, I'm not like, I haven't, I'm right here in this point in my life, and I've seen like the 2006 deal, and I saw the 2018, late 18, early 18, late 15, early 18, late 18, 2020 situations, and you see the reactions to these things, and you're like, okay, and now we're sitting here, and you're looking at some of this stuff, and if it looks like, smells like real life, right?
I'm not there yet. I'm not with you. Completely.
I'm not saying that it is.
I love to think about it though. We'll revisit next Tuesday. We'll see what's going on with seasonality, also kicking in with the go in May and all that stuff, which by the way is a misnomer. It's really make it through July and August and then sell. So I hate the summer months of trading. The liquidity dries up. The A team goes to Europe or the Hamptons or I don't know what, and they just tell whoever's left, don't wreck anything, don't let it get away from us either. So it just goes sideways and choppy mess. But we got to get through May 1st. And speaking of Sem, that you just talked about with the cash flow theory, he's going to be on Thursday. He's going to be my guest captain interview on Thursday. I haven't announced it yet, but he is. And that should be awesome. He's got a fan club because of his prognostications with Vanna and Gary and a whole bunch of other options.
Oh, he's on Thursday.
He's on Thursday.
Oh my God, that's awesome. Yep. That's great. Yeah.
You should help me interview him. That if you're free, that would be fun because you have.
Let me see if I can do it. Yeah.
That'd be awesome. And he's gonna come in with his. I don't know if he's gonna share his model. Probably not. That's proprietary. But we can ask questions and get around it. But I like the cash flow theory a lot. Hyperinflation, I got to warm up to it. Let me say goodbye now, and I'll feed the cat. Wish you a great afternoon. When anything new on the VigTech site, options matrix, do a plug.
Oh, we're doing the mobile app right now. It's awesome. That's a huge improvement. We got a bunch of feedback from everybody, which is great, about how you want this packaged and how you want it delivered. And we're going to package it. We're continuing to load in stuff that's coming hot in. Like the scans are getting further categorized because we keep building based off what people want. So this thing is going to continue to get enhanced over the next couple of weeks. And then we're making this whole thing even easier and easier and easier. Like so especially with the mobile app that's coming out. I can't stress how like simplified that becomes. Like, so
I love it.
I think
you have a web pop-up, you can get a push notification, you can get an email. I mean, what is a pulse though? What's the
the pulse that you can kind of put anywhere in there. It's like kind of your feed, right? So
I think this is awesome.
You can build this out, all you want. We've got Tons of tutorial videos coming out. We've got, we're putting those in multiple languages. We're working with a group that's created an incredible kind of artificial intelligence software that helps create corporate tutorials and things like that, where you can put it in multiple languages and present it to everybody. So that's coming out next week. It's going to be constant, right? It's constant. We're trying to work with everybody. So any feedback people give us, we're absorbing, and please do. And we keep plugging away, right? You know, startup.
You have all the energy to do it too. And okay, so that's it. We're going to be done
and I'm
now.
Crazy.
We're going to be done
crazy.
now. All right. Go.
I'm crazy.
Thank you.
Right.
And Thursday, we'll do it again, 4:00. And if you,
let me see if I can get there. I have no idea. I gotta look at my calendar, but that's a great catch. That's a great conversation. That guy's super smart guy.
Wicked. And we're going to be posting this up here when you're done to my YouTube channel under Macro to Micro Power Hour. So check it out. All right, everybody, have a great evening. Thank you, Jonathan. Bye.
Take care. All right, bye.